Hey everyone, welcome to e-learning. Please remember to subscribe at the end of this video and watch out my other videos. So in this video, I'll be sharing with you 3 of my favorite short patterns and how to actually treat them step by step. And I'll explain to you what these patterns are that I love to trade with and why I love to trade with them. So the chop patterns that I'm about to share with you can be applied for the Forex market, stock markets, the futures market. So don't think that it only works in certain markets, because that is not the case. So if that's it, let's move to the first pattern, which is the false break pattern. And the concept is very simple. And it's that when the market makes a high swing over here, right, then it goes back up a higher, breaking above the highs, and then suddenly the market does 180 degrees reversal and smashes lower and closes near the lows of the candle. So when this happens, you know that traders actually took a long break of these highs, right along the break of this high, since the market is railing higher, and are now trapped because the market did a 180 degrees reversal right there in the rate right now. So they are now so-called track. So this is what I call the false break pattern, where the market breaks above a significant high and then does a sudden reversal closing lower. So if you want to see how it looks like, this is an example of a false break. You can see that this is a high over here, market breaks above the high, and then that's a reversal closing near the lows of the candle. So traders, you can see, right, if they are along the breakout, they announce right because the market has turned against them. So you can actually go short right on this pattern. On the next candle, open over here where you can set your stop loss, right? And it's ideally what you want to set is a distance away from this high, because you want to give a treat, more breathing room, because what can happen is that the market trades higher, triggers above these highs, and then continues trading lower. So give your stop loss more breathing room. I wouldn't recommend being very aggressive with your target, so I try and capture the entire trend. To write the entire reversal move towards the downside, instead, there are 2 options. Number 1 is what I suggest, that you can consider taking profits at obvious swings, highs or lows. So in this case, you're short right, you can consider taking a profit right just before this swinging low over here. That's the first option. The second option is you can trail your stop loss, but my million trillion closely, I don't give it too much wiggle room, because the market can suddenly reverse and continue this uptrend. So if you're short over here, you can drill your stop loss right on the previous candle height. So if the market, let's say for example at this point, the previous candle high is this candle over here. So if the market breaks and close above this previous candle high, you'll exit the trade. So using this second time, you can see that you actually managed to write down this swing down low, because all the way right the market had not broken and closed above the previous day high or the previous candle height, depending on the time frame you're looking. So this is the false break setup that I want to share with you, and it's very simple setup, and the logic is very, very clear. You're just simply profiting right from traders who long to break up, and I'm out. The second one is this volatility contraction pattern. It looks something like this. So just to illustrate, right, is that the market, if you have traded for a while now, you know that volatility is always changing. It moves from a period of low volatility to a period of high volatility. For example, market is a very volatile, then it gets quiet, then volatility can pick up again, then it gets quiet, it can pick up again, gets quiet. So you can see that volatility in the market is always changing from a period of low volatility to high volatility, low volatility, just like that over and over again. So using this concept, you can actually train this particular pattern in anticipation that the market could anticipate, and then volatility could expand in your favor. For example, you can see here that volatility is pretty low, and the range of the candles are getting tighter and tighter. Similar for this range of candles are getting tighter and tighter, right? And yet volatility expansion, here you have a reduction in volatility and then volatility expanded lower. So how can you treat the volatility contraction pattern? It's actually quite simple. This is more towards our trading and breakout. So what you can do is wait for the market to break above the highs, right? And enter your trip, and you can now set your stop loss right reference it from the low of this and this range over here. This mini range that is formed by the volatility contraction, you can set it at a distance again away from the low. So let's say for somewhere right here, and this high over here is where it's your entry with the market, breaks above the highs. If the volatility does expand in your favor, for this type of volatility contraction, move right. Sometimes it's not possible to have a target area to reference to set your stop loss, because you can see that in this portion, you are trading near the highs over here, and on the left side, there's nothing over here to do to set your targets to reference, to set your target profit. So what you can do is, again, use a simple tool like a moving average, right? 20 period moving average, and trail your stop loss and see how far this burst of momentum can go. So if the market breaks and close below the 20 period moving average, then you exit the trade. So this is how you can actually enter a volatility contraction pattern, setting your stop loss just beyond the lows over here. Somewhere here, give it some buffer and then trailing it with moving average, like 20 period moving average. The last pattern I'm going to share with you is the ascending triangle pattern. It looks something like this, and you can see that this pattern is a sign of strength, and the reason why I love to trade is because it's telling you that the buyers, they are willing to buy at higher prices as the market make another higher low. It's telling that buyers are willing to step in and buy at higher prices, and you can be sure that there are traders who will go short just because the market is that resistance. So they'll go short, and where would they put their stop loss? Chances are above these highs, that is where textbook says, as I said, your stop loss above resistance. So what happens when the market have buyers who are willing to buy at higher prices, and you have a cluster of stop loss just above this area of resistance? If the market trades above the highest, you can expect that this cluster of stop loss right would become by others, because if you are short and the market just stops blows, that would transfer into a buy order, and that would fuel further price. And when you are setting your stop loss, again, give it some room for the trade to breathe. So this one over here, you might want to set your stops below this on a swing low over here, because if you set your stop loss in this range, technically the pattern is not invalidated. This ascending trend triangle pattern still holds. So you want to set your stops right where this pattern, this ascending triangle pattern, this is so-called destroyed. So at which level would you set your stop loss where this pattern will get destroyed? That is the question. And for me right now, you want to set it right a distance away from this swing over here. So I would say somewhere here, right? Because at this point, the market reaches this level over here, that this upward trend line is broken. This swing low is broken, and at this point, the pattern is invalidated, it's destroyed, and you want to exit the trade. So for entries, it's required straightforward. Just go along where the price break above the highs. And as for stop loss, as for the target profits, again, similar to the volatility contraction pattern, sometimes when you look left, there's nothing on the left. So how can you now set a target? So what you can do is use a simple tool, the moving average to trillion stop loss. So depending on the type of trade you captured, you're going to capture a shorter term trend. You can use a twinning period moving average. If you want to capture medium term trend, you can go over 50 period moving average, right? Or if you're no longer term trend, you can now go with 100 or 20 period moving average. So this is the ascending triangle chopped pattern, right? And one thing to note, this is again over here, when the market breakout, you have this volatility contraction pattern. If you miss the breakout, this is another pattern that you can trade, and you will know capture the burst of the momentum towards the upside. So as a recap, these are 3 of my favorite chart pattern that I love to create. Number 1 is the false break, where you profit right from traders who long to break out and then go trip when the market does a sudden reversal. The second pattern that I like to trade with is the volatility contraction. Before the market, always changes. It moves from a period of low volatility to high volatility. The third one is the ascending triangle, which is the last one. Please remember to subscribe to my channel.